Welcome back to the Deep Dive. Today, we're going to be tackling something that's on a lot of people's minds.
Yeah.
Saving and investing. We've got a whole stack of sources here ready to break down the differences
Yeah.
and, more importantly, get you thinking strategically about your own finances.
And what's really interesting is that while most people think they're pretty savvy about saving and investing, the reality is
Yeah.
there's a lot of misconceptions out there.
Oh, absolutely. Like, we all know we should be saving and investing, but knowing where to start, that's a whole other story.
Totally.
I think that's what makes this deep dive so important.
Yeah.
It's about demystifying those concepts and giving our listeners practical tools to take control.
Exactly. So let's jump right in. One of the key things our sources emphasize is that saving and investing, while related, actually serve very different purposes in your financial plan.
Okay, I'm all ears. So it's not just about stashing money away.
Right.
There's a strategy involved.
Absolutely. Imagine this. You've got this unexpected car repair. Bam. $1,000 gone. That's where saving comes in.
Okay.
It's your safety net, your buffer against life's little or big surprises.
Right. So it's about having that readily available cash for those just-in-case moments.
Exactly.
But I'm guessing there's more to it than just stuffing bills under the mattress.
Way more. Our sources actually recommend aiming for a specific emergency fund.
Okay.
Ideally, 3 to 6 months of living expenses tucked away in a high-yield savings account.
High-yield savings account. Is that like a souped-up piggy bank?
I like that.
Yeah.
Basically, it's a type of savings account that offers a slightly higher interest rate.
Okay.
Compared to traditional accounts. Think of it as your money working a little harder for you, even while it's sitting there waiting for an emergency.
That makes a lot of sense. So we've got our emergency fund for those short-term needs.
Right.
But what about investing?
Yeah.
That's where things get a bit more
Absolutely. Investing is about long-term growth. Think about those big life goals. Buying a house.
Yeah.
Funding your dream trip. Retiring comfortably.
Okay, now we're talking. But I know a lot of people get intimidated by investing.
Yeah.
It seems risky,
Sure.
complicated.
Yeah.
Where do you even begin?
I get it. Our sources highlight a few key things here. First, investing isn't just about picking stocks.
Okay.
It's about understanding different asset classes like stocks, bonds, real estate, even things like precious metal.
So it's not about putting all your eggs in one basket.
Exactly. Diversification is key.
Gotcha.
Spreading your investments across different asset classes helps manage risk.
Okay, that makes sense. So we're spreading the risk, aiming for long-term growth.
Yeah.
But what about the actual process of investing?
Well, there are a lot of different strategies.
Yeah.
But one of the most popular and effective is dollar cost averaging.
Dollar cost averaging. That sounds intriguing. What's that all about?
It's a strategy where you invest a fixed amount of money at regular intervals, regardless of market fluctuations. Let's say you decide to invest $100 every week.
Okay.
Some weeks prices might be high, other weeks low, but by consistently investing, you average out your purchase price over time.
Ooh, I see. So it's like a steady and consistent approach.
Yes.
Rather than trying to time the market perfectly.
Exactly. It takes the emotion out of investing and helps you build wealth gradually over time.
That sounds much less intimidating than I imagined.
Right.
So we've got dollar cost averaging, diversification, and are there any other key strategies that our listeners should know about?
One that's gaining a lot of traction is index fund investing.
No, that's a term I've heard thrown around a lot. And honestly, I'm not entirely sure what it means.
It's actually pretty simple. Imagine trying to pick individual stocks,
Okay.
hoping they'll outperform the market. It's a lot of work.
Yeah.
And frankly, pretty risky.
It sounds like trying to win the lottery.
Right. Now imagine instead buying a whole basket of stocks that represent a specific market index, like the S&P 500. That's what an index fund does.
So instead of trying to beat the market,
Right.
you're essentially riding the wave of the market's overall performance.
Precisely. Index funds are known for their low fees and their ability to deliver consistent returns over the long haul. They're a popular choice for both novice and experienced investors.
This is all starting to make so much more sense.
Good.
So we've got dollar cost averaging, diversification, and index funds.
Yeah.
What I'm hearing is there are ways to approach investing strategically.
Totally.
Without needing to be a Wall Street wizard.
Exactly. And that's what's so empowering about financial literacy.
Yeah.
The more you understand, the more confident you become in making decisions that align with your goals. But there's another piece of the puzzle we haven't talked about yet. The psychology of investing.
The psychology of investing. Now that sounds like a whole other deep dive.
It is.
Why is that so important?
Well, you can have the best strategies in the world, but if you let emotions like fear and greed dictate your decisions, you can easily derail your progress.
Ooh, I know that feeling. Like when the market dips and you suddenly want to sell everything?
Exactly. Understanding how our brains work when it comes to money is crucial.
Okay.
There are common behavioral biases like loss aversion that can lead to irrational decisions.
So how do we combat those biases?
Yeah.
How do we stay level-headed when the market is doing its roller coaster thing?
That's a great question, and one we're going to explore in depth in our next two parts of this deep dive. Stay tuned.
Okay. So right before we left off, we were getting into how our brains can sometimes mess things up when it comes to investing.
Yeah, exactly. You know, even if we've got a great plan in place, our minds can really play some tricks on us when we're dealing with money. You know, like that whole loss aversion thing.
Loss aversion. I think I know what you mean.
Yeah.
Nobody really enjoys
right.
seeing their investments go down in value, do they?
Exactly. Loss aversion basically means we feel the pain of losing money much more strongly than the pleasure of gaining the same amount.
Makes sense.
And that feeling that can lead us to make some not so great choices.
Oh, yeah. Like what kinds of choices?
Well, for example, we might panic and sell off our investments when the market takes a dip.
Oh, so like panic selling.
Exactly. Even if holding on to those investments would have actually been better in the long run.
Right, yeah, because then when the market bounces back,
right,
you've already sold everything at a loss.
Exactly. It's tough, right? So it all comes down to learning how to manage those emotional knee-jerk reactions.
So how do we avoid falling into those psychological traps? Any advice from our sources?
One of the best things you can do is to create a solid investment plan.
Okay.
And actually stick to it. When you set clear goals from the beginning,
figure
out how much risk you're comfortable with, and have a long-term outlook, you're less likely to make those impulsive decisions just because the market's being a little bit volatile in the short term.
Okay, so it's like having a roadmap for your finances.
Exactly. And remember, investing is a marathon, not a sprint. It's about weathering those inevitable ups and downs and keeping your eyes on the prize.
Right. And speaking of things we can control.
Yeah.
What parts of investing are actually within our control?
Well, you have the power to decide how much money you're going to invest.
Okay.
How often you're going to make those investments, and what types of investments you want to put your money into.
Gotcha.
You can't control the market's mood swings, but you can definitely control how you react to them.
That's actually a pretty empowering way to think about it.
Yeah.
It's not about trying to predict the future. It's about making smart choices, given what's happening in the market right now.
Absolutely.
But what about people who say, hey, I don't have enough money to invest?
Yeah.
What would you say to them?
I'd say that's a pretty common misconception. Okay. You don't need to be a millionaire to start investing. Remember, dollar cost averaging. Even if you're only investing small amounts consistently over time, it can really add up thanks to this awesome thing called compounding.
Compounding. I love that word. It's like magic.
I know, right?
How does that work again?
Okay, so picture this. You invest $100.
Okay.
And let's say you get a 7% return on that investment. Now, the next year, you not only have your initial $100, but you also have that extra $7 you earned in interest.
Right.
Now, here's the cool part. That $107 is now earning interest as well.
Ooh.
So your returns start building on top of each other.
It's like a snowball effect. The more you invest, the faster it grows.
Compounding is like your best friend when you're in it for the long haul. Those small contributions can turn into something much bigger down the line.
That's awesome. This is honestly making me feel way more optimistic about investing. But there's still one thing I'm kind of wondering about.
What's it?
What if everything goes wrong? Like, what if the market totally crashes?
That's definitely a valid concern. And this is where the whole idea of risk management comes in.
Okay, so how do we manage risk? Do we need to become, like, financial experts overnight?
No, not at all. Remember, diversification. That's your first weapon in the fight against risk.
Mm-hmm.
When you spread your investments across different asset classes,
Right.
you're basically minimizing the impact if any one of your investments decides to take a nosedive.
Right. It's like that old saying, don't put all your eggs in one basket.
Exactly. And another big part of risk management is understanding your own risk tolerance.
What exactly does that mean? How do you figure out your own risk tolerance?
It boils down to how comfortable you are with the idea of maybe losing some money.
Okay.
Some people are totally fine with a bit of a roller coaster ride.
Right.
They're willing to accept higher volatility because it also means the potential for bigger gains. But then there are other folks who prefer to play it a bit safer. They'd rather go for slower and steadier growth, even if it means potentially missing out on those huge returns.
So it's a personal thing. There's no right or wrong answer.
Exactly. Your risk tolerance depends on a bunch of factors, like how old you are, what your financial goals are, and just how much you're comfortable with uncertainty in general.
This is really starting to make a lot more sense. We've talked about strategies and the psychology of investing and risk management.
Yeah, it's a lot to take in.
But I gotta admit, there's still a part of me that feels a bit overwhelmed.
I totally get it. Investing can be complex, and there's always something new to learn.
Right.
But that's where those financial advisors can really come in handy.
Ah, yeah, those financial gurus. But isn't hiring a financial advisor super expensive?
Not always. There are all sorts of advisors out there
Okay.
with different ways of charging for their services.
Okay.
Some might charge you a percentage of the money they're managing for you.
Yeah.
Others might have an hourly rate.
Okay.
And some even offer a flat fee for specific things.
So there are options for people with different budgets.
Absolutely. A financial advisor can help you create a plan that's specifically designed for you, answer any questions you might have, and just guide you along the way as you navigate this whole world of investing.
So it's kind of like having a coach in your corner cheering you on and making sure you stay on the right track.
Exactly. And they can also help you with some of those more complicated financial decisions.
Okay.
Like figuring out retirement planning or how to save for your kids' education.
Okay. I'm starting to see how valuable it could be to have a professional on your team.
Right.
So we've covered so much ground today: saving, investing, managing debt, the mental side of it all.
Yeah, we have.
I feel like my financial IQ has gone up like 10 points just from having this conversation.
That's awesome to hear. And remember, financial well-being isn't a finish line.
Right.
It's more like an ongoing journey. It's about constantly learning and adjusting and making those smart choices that line up with what you want to achieve.
So as we kind of wrap things up here,
what's the one main takeaway you hope our listeners walk away with today?
I think the most important thing is to remember that you're in the driver's seat when it comes to your financial future. It's not about getting lucky or just hoping for the best.
Right.
It's about taking charge and making choices that are based on knowledge.
It's about understanding the tools and strategies that are out there and figuring out what works best for you.
Exactly. Whether you're building up that emergency fund, investing for retirement, or tackling that debt head on, every step you take moves you closer to that financial freedom.
And remember, you don't have to go it alone. There are people and resources out there to help.
Right, like those financial advisors and credit counseling agencies.
Exactly. They can guide you and support you every step of the way.
So before we sign off, I want to leave our listeners with a question.
Okay.
What's one small action you can take right now to move a little bit closer to your financial goals?
Yeah, that could be setting up that automatic savings transfer.
Doing some research on investment options, or even just making a list of all your debts and figuring out a plan to tackle them.
Every journey starts with a single step. What will yours be?
Thanks for diving deep with us. We'll be back next week for part 3 of this episode about saving versus investing. Until then, keep those brains curious and those financial goals in sight. So we were talking about taking those first steps towards financial well-being.
Right.
But for some folks, taking that first step can feel like they're already behind.
Yeah.
What about people who are already dealing with a lot of debt? Where do they even start?
That's a really common situation, and it can definitely feel overwhelming. But you know what? It's not about how much debt you have. It's about having a plan to deal with it.
Okay, so let's dive into some strategies.
Yeah.
What are some things people can do to start chipping away at that debt?
Our sources talk about a few different approaches.
Okay.
One popular one is called the debt snowball method.
Debt snowball.
Yeah. Basically, you focus on paying off your smallest debts first, no matter what the interest rates are.
So it's like getting those quick wins to build momentum.
Exactly. Each time you pay off one of those smaller debts, you free up more cash flow to put towards the next one.
Right.
It's a great way to stay motivated and see real progress.
I like that. It's like a little psychological boost to keep you going. But what about those debts with really high interest rates?
Yeah.
Wouldn't it make more sense to pay those off first?
That's where the debt avalanche method comes in.
Debt avalanche.
Yeah. This one focuses on paying down the debts with the highest interest rates first.
Okay.
Which can definitely save you money in the long run.
So it's more strategic.
Right.
But maybe not as motivating if those high interest debts are also the biggest ones.
Yeah, that's true. It really comes down to what works best for you and your personality.
Right.
Some people need those quick wins to keep them going, while others are more focused on minimizing those interest payments.
Right.
The important thing is to pick a method and stick with it.
Consistency is key for sure. But what about those situations where the debt just feels completely out of control, like you're barely making ends meet?
Yeah, in those cases, it's crucial to reach out for professional help.
Okay.
There are credit counseling agencies that can give you guidance and resources, and they can often negotiate with your creditors to maybe lower your interest rates or work out a payment plan that's more manageable for you.
So it's like having someone on your side to help you navigate all that complicated stuff.
Exactly. And remember, there's no shame in asking for help. It's a sign of strength that you're committed to taking control of your finances.
This has been amazing. We've learned about saving and investing and managing debt and the psychology behind all of it. I honestly feel like I've leveled up my financial knowledge just from this conversation.
That's fantastic to hear. And, financial well-being, it's not a destination, it's a journey. It's all about constantly learning and adapting and making smart choices that line up with your goals.
So as we wrap up this deep dive, what's the one thing you really want our listeners to take away from all of this?
I'd say the most important thing is to remember that you have the power to shape your financial future.
Yeah.
It's not about luck or circumstances.
Right.
It's about taking control and making informed decisions.
It's about understanding the tools and strategies out there and figuring out what works for you.
Exactly. Whether it's building an emergency fund, investing for retirement, or tackling that debt head on, every step you take moves you closer to financial freedom.
And remember, you don't have to go it alone. There are resources like financial advisors and credit counseling agencies to help you along the way.
Absolutely.
Well, this has been an incredible deep dive. Thanks so much for joining us, and we'll see you next time on The Deep Dive.